now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks. I don't think people are paying enough attention to the big cycle.
Ray Dalio was back on CNBC last week and is warning investors that there could be significantly more pain in the stock market in 2023. In fact, Dalio expects stocks as a group to perform so poorly that he believes cash currently offers a better relative return. In the exclusive interview, Dalio gave his best explanation yet of the long-term debt cycle and how it affects us as we participate in the economy, and how it helps to explain what the economic environment may look like over the next few years. Ray Dalio is one of the most successful investors of all time, with a net worth of $19 billion, primarily built through founding Bridgewater Associates, currently the biggest hedge fund in the world. Today I'm going to share some clips from his latest interview where he talks about the long-term debt cycle as well as what assets are likely to do well going forward from here. Also, I'm trying to hit 200,000 subscribers by the end of the year, so if you're not subscribed, just going below and hitting that little red button helps me out a ton, so I really appreciate it. But with that said, let's jump into the video. Ray Dalio is one of the few people I turn to learn about the economic machine because he does a terrific job at breaking down the complexities of the finance world into a few key building blocks, forces, factors that ultimately influence what we see and what happens. The economic machine has three key components: a productivity curve, a short-term debt cycle, and a long-term debt cycle. An economy is simply an aggregate of many individual transactions between people, businesses, and governments. Transactions where money is being exchanged for goods, services, and financial assets such as stocks. Productivity is the simplest part to understand. Over time, humans get better at making products and services through an accumulation of knowledge, which ultimately raises our living standard, and Dalio calls this the productivity curve. For example, the knowledge we now have about creating motor vehicles has caused a dramatic increase in efficiency of supply chains, which has reduced the cost of goods and services and improved our living standards. Over the long run, productivity drives economic growth, but in the short term, it's debt that drives the swings we see in the economy. And that's because debt essentially allows us to consume more than we produce when we acquire more debt, and forces us to consume less than we produce when we have to pay it back. In the case of the short-term debt cycle, it typically takes place over a 5 to 8 year period. The increased use of debt drives higher spending, and when spending exceeds production, we get higher prices, or ultimately what we call inflation. This is where the central bank steps in to raise interest rates to slow down inflation. Those higher interest rates increase the cost of debt, forcing people to spend more on their debt financing rather than spending elsewhere in the economy. Less money spending causes prices to decline and leads to a recession. And if inflation is no longer an issue, then the central bank will lower interest rates, starting the short-term debt cycle all over again. There have been 12.5 short-term debt cycles since 1945, with the last full cycle beginning in 2008, when the Federal Reserve lowered interest rates to 0% during the global financial crisis. And that cycle ended in 2020 when the pandemic recession once again forced interest rates to 0%. But not only are we currently in the middle of a short-term debt cycle, we're also right at the beginning of the long-term debt cycle, which typically takes place over 75 to 100 years.
There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money.
The beginning and end of these debt cycles that take place over multiple decades is something that has severe consequences for investors, and it's also something that no one alive today, or very few people who are alive today, would have experienced before. While the amount of debt increases and decreases in short-term cycles, it also tends to accrue over multiple cycles. In his latest memo, Dalio said, "Debt liabilities and debt assets have virtually always increased to make the long-term debt cycle expansion. In all cases, this has continued until the debt burden has become unsustainably large, or the debt assets have become intolerably low returning, at which time there are big reductions in debt liabilities and debt assets that take place through a mix of debt restructurings and debt monetization. These are the big debt crisis periods." The best way to understand what Dalio means by these long-term cycles is to simply walk through the long-term cycle that has just taken place place that began in 1945 and has recently ended. The long-term debt cycle has 4 phases. First phase began in 1945 when World War II ended and the US secured its position as not only the strongest economic force but also the strongest military power, ultimately giving them control of both money and geopolitics. From 1945 to 1971, the US dollar was also backed and tied to gold, which meant that you could essentially exchange your dollars if you wanted to for gold at the Federal Reserve. There were 5 short-term debt cycles during this period, which were categorized by the US overspending and funding that overspending by using more and more debt. Eventually, some countries that held a lot of US dollars realized that the US had way more claims on gold than actual gold to exchange for the US dollars, and they started to exchange their US dollars for gold. And this caused essentially a bank run on the US. But since the US didn't hold enough gold to exchange for those dollars, the US essentially decided to just sever the tie between the US dollar and gold, and today's fiat currency was created. As you might expect, this caused a dramatic devaluing in the currency. From 1971 to 2008, the US dollar was devalued severely, and during this period, there were also 5 short-term debt cycles, each with interest rates ending lower than the last, providing a huge tailwind for asset prices. In 2008, the global financial crisis caused interest rates to hit 0%, meaning the maximum effect of lowering interest rates had been reached, and a new type of monetary policy by the central bank would be needed to stimulate the economy. This marked the last phase of the long-term debt cycle, which is where there is rapid debt monetization, which in 2008 came in the form of quantitative easing. The Federal Reserve turned on its money printer and started buying a lot of government bonds. And this also continued in 2020 when the government needed even more money to fund its COVID stimulus checks. So again, the Federal Reserve printed trillions of dollars and bought government bonds. And what came next should have been little surprise to anyone. A huge amount of inflation came from all of this additional spending. And that brings us to the last couple of years, which I'm sure most of us are pretty familiar with what's been happening. To get inflation under control, the Federal Reserve has been increasing interest rates since mid-2022. And as a result of the increased interest rates, speculative stocks have collapsed and even the broader market has done pretty poorly. So where are we today and going forward, and which asset classes does Dalio believe will do best in the future? Just before I get to that, I do want to talk about the sponsor of today's video, the Daily Upside. There is so much noise in the financial media landscape, and it can be really difficult to sift through the huge amount of disingenuous headlines to find real, reliable sources of information. The Daily Upside is the solution to this problem. It's totally free, and you get a financial brief sent to your email each morning, which covers the most important news and stories of the business world to start your day. It's concise, informative, and witty, and leads to more detailed stories about what is happening around the globe in the finance and business world. There's coverage of corporate news, the economy, policy changes, and investing news, all coming from a team of financial professionals. As someone who needs to have a finger on the pulse of what's going on in the finance world to create content like this, the Daily Upside has been a fantastic way to start my morning. Just the other week, I read a fascinating story about the Google and Twitter Supreme Court cases for the liability of terrorist content on social platforms. Both cases are challenging Section 230's protection for internet platforms, the long-standing rule that grants websites legal immunity for hosting potentially illegal content posted onto their site by outside users. This is a really interesting story, and I may have completely missed this if I didn't see it in my morning brief from the Daily Upside. So whether you're a financial professional or just someone looking to get a jumpstart on what's moving the markets, the Daily Upside is a great way to start your day. It's totally free, and they send you one information-filled brief each morning to your email. Join the hundreds of thousands of investors who trust the Daily Upside and sign up via the link in the description. The markets now actually believe that interest rates will be going down over the long term from here.
This market, depending on what you think this market is, it actually believes that inflation's coming down. And they don't believe Jay Powell to some degree.
I think what you're referring to is they don't believe what's in the curve. Or in other words, what's in the curve is a significant easing.
Yep. Right.
What Jay Powell is saying is steady.
Right.
Believe steady.
Mm-hmm. You're saying believe steady. You're saying believe what Jay Powell is saying.
Right.
We know this because we can see what's priced into the bond yield curve, as short-term rates have significantly higher yields than the further you look out. But this flies in the face of what the Federal Reserve has been suggesting, with Jerome Powell telling investors that rates are going to be steady going forward. And Dalio agrees.
But I think that this type of recession is not a bad recession. It's a lot less bad than I thought it would be.
Despite the expectation that rates will remain relatively high, Dalio believes the recession we may see in 2023 will be less worse than he previously thought. He says the real issue with the US is their debt, that they've borrowed an enormous amount of debt and are currently having a difficult time selling it around the world. And that puts the Federal Reserve in a very difficult position trying to balance two key factors, inflation and the debtors. They need to have an interest rate that is high enough to offer real returns that exceed the inflation rate, while also not raising rates too high for borrowers such as businesses and governments who are debt burdened and seeing their interest payments rise.
So you're seeing this type of contraction. So it's going down, and we're having something close to a let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate.
Right.
Something like that, right?
Finally, in the interview, Dalio gives us some insights into which assets he thinks will perform well in the environment we face.
Now cash is relatively attractive.
Right.
So it's attractive in relation to bonds. It's actually attractive in relation to stocks.
Dalio believes that cash looks pretty attractive right now, especially compared to stocks. He thinks this for really two key reasons. Firstly, when it comes to cash, their real returns have shifted from being quite negative to actually now being positive. Back in 2022, the annual inflation rate far exceeded what you could get from a government bond, meaning your real return after inflation was negative. In the recent months, short-term bonds have actually offered a return that is exceeding the short-term inflation rate. At the same time, Dalio believes there could still be more pain in the stock market to come in 2023.
Every investment is a lump sum payment for a future cash flow, and you put in the discount rate. So now you've moved the discount rate. That discount rate is not going to be materially changing, right? So we're not going to go back to the old discount rate, and prices are not going to go back to where they were. Then you start to have the knock-on effect on the economy.
And the relatively high interest rates also have an effect on the future cash flows, the other component, whereby higher interest rates means that there may very well be somewhat of a knock-on effect into the economy that affects businesses and their cash flows. So in essence, he believes that a combination of rising or stable interest rates with slow, stagnant economic growth will mean that returns for investors in equities will be relatively poor from here. Again, I think it's important to mention how this impacts how you should be investing. If you're a value investor like me, you really don't care about macroeconomic predictions that are made by people like Ray Dalio, especially because at the end of the day, even though he may be right that as a group equities are not going to do as well as they have in the past, on an individual basis or a particular sector or a particular industry or a particular market, there will be businesses and investments that continue to do well, and as a value investor, your job is to try and identify those opportunities. And while Dalio does do a great job at explaining the economic machine, his track record on whether you should be in cash or out of cash has been pretty bad recently. I mean, just as recently as the start of 2022, he was still saying that cash is trash, and cash ended up doing far better than stocks and bonds that year. So it's entirely possible, as he sits there today and says that cash is a good place to be, that cash may actually do far worse than equities and even bonds. And if we zoom out even further, which is in my view how you should think about investments, then over a 10-15 year period or even longer, there's almost no scenario where cash will be doing better than, say, US equities. Check out my other videos on Ray Dalio down in the description below if you're interested. Hit subscribe if you enjoyed the content, and I'll see you guys in the next video.